Hello, my name is Mark R. LePage. I'm the founder of EntreArchitect. And yesterday, April 27th, 2020, I presented the EntreArchitect Profit Checklist, a webinar that teaches the P2P Financial Management System. Today, here on YouTube, I wanted to share that webinar with you. I actually presented it twice yesterday, once at 12 o'clock Eastern Time, and then again at 4 p.m. Eastern Time. This is the 12 noon session, and I just wanted to share it here with you today at the EntreArchitect YouTube channel. Hope you like it. Have a great day. Welcome, welcome. While we're waiting, if you could just post in the chat box where you are located. Udai, you got me. You beat me. You beat me to it. India. Boise, Idaho. Portland, Oregon. Richmond, Virginia. Another India. Albuquerque, New Mexico. NYC. Tulsa. All right, we have way over 100 people registered for this session, so we should have a lot of people coming in. Los Gatos. Monroe, Louisiana. Hi, Rod. Peter from Atlanta, thank you. Lots of friends from India, Brazil. Welcome. Philippines. All right, we have a global audience today. All right, let's get started. Mr. Wintner, are you ready to roll?
I am ready, sir. Welcome to all of the participants.
All right, let's get started. The EntreArchitect Profit Checklist, 7 essential elements of a proven financial management system for architects. My name is Mark R. LePage. I'm the founder of EntreArchitect. I am also a partner with my beautiful wife, Anne-Marie McCarthy, at 5 Cat Studio Architecture. We do residential architecture here in about 30 minutes south of Charlotte, North Carolina. We were born and raised up in New York. We practiced in New York for about 20 years. And last July, we made the move south to Charlotte, North Carolina, and that's where we are now. Moved to follow some family that's down here. Our brothers are down here, and my mother and father-in-law are down here. And so we're really enjoying it. I think what I like most about Charlotte, although it's pouring rain right now, is that summer starts sometime in late March. It's very different than New York. New York summer still is a long way away. So I really enjoy it here, and we're liking Charlotte a lot. I am also here with my friend and mentor, Steve Wintner, AIA Emeritus. He is the founder of the P2P method. He created the method. The profit checklist and everything that we're going to talk about today is based on the P2P method of financial management for architects. Steve is an architect and a management consultant. He's the founder of Management Consulting Services. He is the author of a book that may be sitting on your shelf, Financial Management for Design Professionals, The Path to Profitability. And if anybody is wondering where P2P comes from, right there, Path to Profitability, P2P. He is also the editor of the financial management chapters of the AIA Handbook of Professional Practice, the 15th edition, which also may be sitting on your shelf. He's the man who wrote those chapters. And the P2P method is what we teach at EntreArchitect. He's also a friend, a very good friend, and a very good mentor to many of our past and current members. He's also a good friend and a mentor to me. He is dedicated to the profession, and he's dedicated and passionate about teaching architects financial management, and he is here with us today. Steve, do you want to say hello?
Hello, hello, hello. Delighted to be with you all.
And Steve will be managing the chat box. So as we move along here, if you have any questions about anything I teach, he will answer any questions you have. Just post them in the chat box, and he'll post them. We're also going to have a Q&A session at the end, and we'll do that on the recording. And so any good questions that you post during the session, we'll also do live on the call. Why is this webinar so important? Oh, and we've done this webinar many times, and it's been in very good times, right? The economy has been really good, and now the economy seems to be doing okay, but it's obviously slowing, and in some places it is not good at all. And so this webinar is important because finance is the foundation of everything that we do as business owners, right? Architects, entrepreneur architects, are business owners, right? If we run and practice, and we have small businesses. Our firms are our small businesses, and when you are looking at the fundamentals of business, finance is the foundation of everything. It really is the thing that everything else is based on. Your marketing strategies, your sales strategies, your staffing strategies, all of it is based on the money, right? The cash flow that comes in and out of your architecture firm. And so it's the most important thing, right, for your firm in good times and bad. And it's right now, in this time that we're living in, it is the single most important thing you can do to prepare your architecture firm for this changing economy that we're seeing happening right now as we're presenting this. It is the most important thing that you should be focused on in order to prepare for the economy. If you are preparing to survive this economy, you must have a functioning financial management system and understand how to leverage it for your success. Because in good times, it will make you more successful, right? It'll make you more money. It'll bring in more money and allow you to do all the things that you want to do as an architect. But in a challenging economy, in a down economy, in a recession, it is the thing that will allow you to survive. It'll give you the data, the real-time data that you need in order to make the adjustments on a real-time basis, in order to see the things that are happening and understand what you need to do in order to survive the economy. And so what we're doing here at this profit checklist is we're going to show you inside the system, the P2P system that Steve has created, and the system that we teach at the P2P Profit course. The Profit course right now is available. We launched it last week. One of the reasons why we've brought this back, because we did the Profit workshop earlier this year. We typically do the Profit workshop once per year. And so we did it once last year. We did it earlier this year as scheduled. And then COVID-19 hit the world and the economy shifted, right? And so we see this as a time where we need to focus, we need to plan, we need to get ready for the times that are coming our way. And so Steve and I discussed it, and we wanted to relaunch everything. So we wanted to provide this webinar. We wanted to open up the Profit course. You can go and purchase the Profit course. The Profit course is a pre-recorded version of the workshop that Steve and I do. The workshop is also available. The workshop is available at that same link, EntreArchitect.com/profit course. You can buy the course, or you can enroll for the workshop. The workshop is starting on Tuesday, June 9th, so that's a couple of weeks from now. It is the workshop. I will go into the workshop and all the details on the workshop later in the session, but I wanted to post it up here early just so you know those things are available in case you need to run out at the end. I will show you all the details of the workshop at the end of this session, but you can learn everything at EntreArchitect.com/profit course, and you can learn about the course itself if you want to buy the pre-recorded course, or if you want to enroll in the 5-week interactive training program where Steve and I actually walk you through the process over 5 weeks, and we'll talk about that later on. So this session, this webinar, is the 7 essential elements of a proven financial management system for architects. It's the P2P process. It's the P2P method. It's what we teach in the course and workshop, consolidated right into it'll be about an hour, maybe 90 minutes. We try to target an hour, but it usually ends up 90 minutes. So you can sort of schedule your day around this. This is going to probably be about 90 minutes. But this webinar will take you into the content that we teach in the course and the workshop. Today's goals: we want to provide you with the basic knowledge and understanding of a proven financial management system for architects. We want to help you earn that minimum of 20% profit this year and beyond. That's the goal of the workshop and the course. The P2P method is to show you how to earn a minimum of 20% profit. Steve says that every firm should be earning 20% profit. And if you're not earning 20% profit this year and any time, then you need to plan for that. And the system shows you how to do that, how to, even in bad times, how to make the adjustments in order to get as close to that target as you can. And goal number 3, we want to keep it simple and fun and worth your valuable time. I know you're busy, right? I'm a small firm architect too. I know that this takes time out of your day, right? So I appreciate you for being here, and I'm glad that you're here to learn what we're going to teach, and we're going to try to keep it valuable to you. So let's start with some definitions. Architects are artists, and architects are architects. We're not business people. We're not financial management people. We don't know this stuff. We weren't taught this in school. And so let's start with profit. What's profit? Profit's the dollar amount remaining after your salaries, consultants, and expenses are paid. On the accrual basis profit loss statement, gross profit is the dollar amount remaining after all operational expenses are paid, but before the miscellaneous non-operational revenue and expenses are taken into account. Now, net profit, which is different than gross profit, net profit is the dollar amount remaining after those miscellaneous revenue and expenses are taken into account. And we're going to get into all this, so you'll understand that as we go. But before the taxes and distributions, the employee bonuses and the shareholder dividends, those are the miscellaneous stuff. After the miscellaneous stuff is all paid up, then that's net profit, right? And that's what we're talking about. The financial goal for every architecture firm should be a minimum of 20% net profit. So bottom line, that's where that term bottom line comes from. It's the net profit. Okay, now there's 2 different ways of accounting, right? And you probably have seen this little toggle switch on your QuickBooks software or whatever software you're using. You can switch back from cash basis to accrual basis. Cash basis accounting is a method of accounting in which income is recognized when the payment is received and expenses are recognized when they are paid, right? So at the time of the moment of the actual transaction, that's where it gets recorded, where the transaction occurs, right? Income taxes should be calculated on a cash basis because the firm should only pay taxes that the money actually has received, right? That the firm has received, the money that it has received. So cash basis is an accounting method, right, for taxes. Accrual basis, which is what the P2P method is based on, is a method of accounting which revenue is recognized in the period in which work is performed and the expenses are recognized in the period in which they occur, right? So it doesn't matter the timing of the exchange of the cash. It doesn't matter when you get the check in the mail. It matters when the work is performed and when the expenses occur or are recognized in the period in which those expenses occur, right? Not when you pay them, it's when you receive the invoice. And so the accrual basis accounting is what the P2P financial management system is based on, because our goal is to plan for profitability. We're talking about how do we earn 20% net profit. That's what the P2P financial management system is based on and works on. So the accrual basis accounting is critical to develop this system. So what are those seven essential elements of a proven financial management system for architects? Well, there needs to be a structure. It's based on time. We need to have a budget. We need to have a plan. We need to have reports, right? So we know what's happening, so we can track what's happening. We need to have metrics so we can gauge how those reports are working, right? The data is important, but if we don't know the value of that data, then the data is unnecessary. Doesn't mean anything, right? If you don't know what it's based on. And then fees, right? So those are the 7 essential elements of a proven financial management system. So the system itself, if you're looking at the system itself, those 7 items relate to the chart of accounts, which we're going to go through, time tracking, annual budget, your annual profit plan, your financial statements, your key financial performance indicators, and your project fee budget. Those are the 7 elements of the P2P financial management system. Also, just as a reminder, not only is Steve here to answer questions in the chat, he's also here to keep me honest. So along the way, you might hear Steve jump in and correct something I say or clarify something. So I just wanted to invite Steve to do that, but also to remind everybody that he may be doing that as we move along. And whenever he does that, I jump out of my chair. So so just we should all expect that. That's why I invite Steve to keep me honest here. It's his system, and I want to make sure that we're teaching it properly. All right, this is the financial management cycle, the P2P FM cycle, the financial management cycle. This is what we just talked about, right? The 7 elements. It starts with the chart of accounts in the middle, and right here, chart of accounts right in the middle, and then it's the cycle, right? Management cycle. So it's a circle and it runs around the chart of accounts. There's a horizontal line right through the middle of the circle. And there are arrows that show the direction of that circle. And so everything starts off with a chart of accounts, and everything above that horizontal line is the forecasts, right? It's the future. It's the future financial and business activity. It's the planning, right? And then everything below that horizontal line is what actually happens. It's the current financial status. It's the business activity. It's the things that are actually happening in your firm. So everything above the line is the planning. Everything below the line is the actual actual historical data that's happening in real time. And so you start with the chart of accounts. All of it's based on the chart of accounts, and then it goes from the annual budget to the profit plan. And these 2 items work together, the annual budget and the profit plan. We're going to go through each one of these today. Then the project fee budget. That's how you put together a project fee based on a profitable project fee to make sure that your fee includes profit. Then it gets into key financial indicators, the profit loss statement and balance sheet, and time tracking. And so this is the P2P financial management system. This is what we teach in the profit workshop and the profit course. We dive deep into each one of these. The course goes deep into each one through a recorded video, and the profit course, we teach it live, and we do homework and all that stuff. We're going to show you each one of these today at the profit checklist. We'll basically look at it like a checklist, right? These 7 items are the 7 things that you need to have in your financial management system in order for it to work. We're going to start with a chart of accounts. So what's a chart of accounts? A chart of accounts is a complete list of all revenue, money in, and expenses, money out, right? The revenue is the money coming in, and expenses is the money going out, to which all financial transactions can be charged or posted, right? The chart of accounts is the building block for every accounting system. Every accounting system that you might be using, all the software, they all have a chart of accounts. It's the organizational structure, right? We went back to those 7 items. Structure, chart of accounts is your structure of your financial management system. And we have a P2P, our chart of accounts, and it is the organizational structure for your money. And the P2P method has 2 parts, right? There are two charts of accounts for the P2P method of accounting. There is the accrual basis profit loss chart of accounts, right? So there's a chart of accounts that's related to the profit loss statement. And then there's also the accrual basis balance sheet chart of accounts. And Steve has broken them up so it's clear that the profit loss chart of accounts relate to the profit loss statement, and the balance sheet chart of accounts relates to your balance sheet. So your accrual basis profit loss chart of accounts, and you might also notice that I'm saying profit loss. That's a pet peeve of Steve's, and now it's a pet peeve of mine now that I know. So many software packages say, and many people say, profit and loss, or profit and loss, right? Profit and loss statement. It can't have a profit and a loss, right? It's profit or loss, right? Profit loss statement. And so the accrual basis profit loss chart of accounts includes revenue, expenses, direct labor, and expenses, direct expenses. So direct, what's the difference between direct labor and indirect labor? So whenever you hear the term direct, it means project related. So it's labor that's associated directly to a project. So time or effort that's being put into a project that's directly related to a project. So expenses that are directly related to a project is expenses that are direct labor and direct expenses. Indirect labor are non-project related labor and expenses, right? And so when you see the word direct labor, it means that it's project related, and indirect means that it's non-project related. So all the other things that make businesses run that are not directly related to a project would be indirect expenses. And each one of these items are represented in your chart of accounts. And then there's miscellaneous revenue and expenses and distributions. So that's how your profit loss chart of accounts is structured. It has each one of these. The balance sheet chart of accounts includes current assets, long-term assets, current liabilities, long-term liabilities, and shareholder equity. And we're going to go over all this in this webinar. So we're going to go through all of this so you can understand how this works. So the profit loss chart of accounts, I'm going to quickly jump off the slideshow here and pull up a sample chart of accounts that we use. Here's our sample chart of accounts, the profit loss chart of accounts, the P2P system developed by Steve over the years, and it's constantly evolving. Even through the workshops, we're constantly making it better or answering questions or revising things. But it's basically broken down into revenue. We talked about all the different pieces. So here's revenue. You have your total fees billed. You have your total reimbursable expenses billed. You have your total outside project consultants fees incurred, and I'll get to that in a second, right? That's sounds like an expense, right? Total outside project consultants fees incurred, and total project related expenses, both reimbursable and direct expenses that are project related, incurred, right? And so that equals revenue. So that's the money in. So how could fees that you are incurring and project related expenses that you are incurring equal revenue? Well, I don't want to get too deep into this because we go through a whole section of this on the workshop and the course. But basically the idea is that the outside project consultants fees incurred and the total project related expenses that are incurred allow you to capture the markup on that project related expenses and the markup on the reimbursable expenses that are incurred. And so by bringing these items in and then later removing them, it allows us to calculate our total real revenue, right? So you have your total reimbursable expenses billed, and then you have your outside project consultants fees that you incur, then you get a markup on that, and then you pull them back out. And then your project related expenses, there's a markup on those, and then that also comes back out. So in order to have a net operating revenue, and we'll talk about that when we get into the profit loss statement, it'll make more sense. I'll dive a little bit deeper into that later. But this is the equation here. So section 4110, total fees billed, plus section 4150, total reimbursable expenses, minus the total of 4170, which are all your consultants, right? So all the consultants would be listed under 4170. And then 4190, total project related expenses incurred, would also be subtracted out. And that gives you your net operating revenue. And everything is now tied back to that net operating revenue. So all of your expenses, right, now all come out of your revenue. And so you have your direct labor expenses. So the salary for your principal, your project and technical people, your administrative staff, and your contract, right? Independent contractors are also listed here, 5180. That gives you your total direct labor. And then you have your direct expenses, so your consultants, and then your reimbursable expenses, which relate back up to the items above, but these items are here in order to have something. If your software doesn't allow you to have negative items in your revenue, you can still track that through these items as expenses in your software and then come back and do those calculations outside of the software. Again, I don't want to jump too deep into that. We go deep into it in the course and the workshop. If you do have specific questions about that, don't hesitate to post those in the chat, and Steve can answer them, or we can answer them at the end. We have indirect labor expenses, and we get into the expenses that you might recognize: vehicle expenses, banking fees, and interest expenses, professional services for your business, depreciation and amortization, taxes, and then marketing and business development expenses. So pretty much everything that your firm would need is listed, and it has a number, right? And so these are the P2P chart of accounts numbers. So C equals your total indirect labor and expenses. And then total expenses would be B plus C. So we have B up here. You can go back to B. B is your total direct labor here. And then C plus C gives your total expenses. And then A, which is your revenue, minus your total expenses, gives you your gross profit loss. And then you come over to the right side of the chart here, and you have your indirect expenses. Well, these are more indirect expenses. Down here would give you your miscellaneous revenue and expenses. So total miscellaneous revenue and expenses. Then E plus F gives you your net profit or loss, right? So your E is your gross profit. I'm sorry, hold on. G, your net profit or loss. And then total distributions gives you your net profit loss, right? And so this is your sample accrual profit loss chart of accounts. You can see how it's structured. Also, everybody who has registered for this session is going to get a recording of this session, right? So when you registered, you gave us your email. We're going to send you out a copy of the recording of this. So if you want to come back to this and go through them a little bit slower, you can go and you can look at how this system works. And so we'll come back to that later when we do our profit loss chart of profit loss statement. Let's just go back to our slides, and then we're going to go to our balance sheet chart of accounts. We're going to do that same thing real quick with our balance sheet chart of accounts. Okay, here's our balance sheet chart of accounts. Structured similarly, it's structured to match your balance sheet. So you have your current assets, which is your cash, right? That's your checking accounts, savings accounts, cash. Your accounts receivable, right? So you have the money that's coming in. Your work in progress, right? So that's the work that's been earned but not yet billed. So that's would go on your balance sheet. Prepaid expenses like insurance and other things like that. Oh, I see another update we need to make. We have a misspelling there. Long-term assets, accumulated depreciation and amortization, and then other non-current assets. That gives you your total assets. And again, we're going to dive into the balance sheet later, which will help make sense of what all these things are. The intent of this section of the webinar is really just to show you how this chart of accounts is structured in terms of headings and numbers and that kind of thing. but it's all there for you as part of the P2P system. Now, the P2P system is based on that, right? So that was the middle of that cycle, right? The financial management cycle. So the chart of accounts is in the middle, and everything else runs off of that chart of accounts. So now we're going to talk about time tracking. Why time tracking is the second most important thing? Because everything is based on time, right? Everything in the system is based on time. So time tracking is critical, whether charging a lump sum, right? Because you might say, well, I don't charge hourly. Why do I need to worry about tracking my time? Whether you're charging a lump sum, a percentage of construction, a fixed fee plus expenses, or an hourly fee, an architecture firm's profitability is based on the hours worked and accurately tracked by everyone in the firm, right? The system is based on time. You can't track your profitability if you can't track your hours. A firm's profitability is based on the hours worked and accurately tracked by everyone in the firm. Everyone, accurately. Those are key words there. That means you too. 6 rules for tracking time at your firm. Organize your timesheet to reflect your chart of accounts, right? So you can track your time based on the chart of accounts. Track direct labor, project-related labor, right? Direct labor is project-related labor. Track direct labor and indirect labor, non-project-related labor, separately. So your time sheets, your time tracking tool needs to track your project-related labor and your non-project-related labor separately, because they do different things. And so you need to track them separately, and you'll understand why as we move forward here. You need to provide a non-regular hours column to track beyond the full-time hours of 2,080 hours. 2,080 hours is a 40-hour work week, 5 days a week, right? And so you need to be able to provide a non-regular hours column for the time that's worked beyond those 40 hours in order to be able to calculate your profit and plan for profit accurately. Use a pre-formatted time journal to make time tracking simple. So put together a time journal that people can use in your firm, or you can use in your firm, that makes it easy to track your time. So it's easier to track it than to try to figure it out later, right? If you have something that's pre-formatted and it's all set and ready to go, people in your firm and you may be more likely to track your time throughout the day, twice per day. That's the minimum. Record your time twice per day, once around lunchtime and once at the end of the day. And that way you can keep track on a regular time. Remember, it's everyone, which means you too, including your administrative staff, all of them, including your contract labor hours, so you can track those too. Everyone tracks their time, including the administrative staff and the principals, right? And that may mean you. I know a lot of principals say, I don't need to track my time. Yeah, in order to track your profitability, you need to track your time. And so time tracking is a critical element to a successful financial management system. Without it, none of the rest of what we're going to talk about matters, right? So if you're resisting tracking your time, click exit because everything in a financial whether it's our financial management system or some other financial management system, it's based on time. Right, the profitable hours of a service industry, of a service professional such as us, it's based on the time you spend. All right, so the next item, the next essential element is annual budget. Your annual budget is based on your chart of accounts, and it's a monthly, month-by-month projection. It's a month-by-month projection. So a projection is a plan, it's a future plan, right? It's a projection of what future revenue and expenses may look like for 1 year. So your annual budget is a month-to-month projection of the future revenue and expenses for 1 year. So you're projecting, right? You're guessing, or you're basing it on past data, but you're looking at the year to come, 1 year ahead, and you're deciding, okay, this month we're going to have this much revenue and this much expense in this month, right? So the annual budget is you're planning this out, your month by month projection of your future revenue and future expenses for 12 months. So let's just jump into what a annual budget looks like. Okay, this is the P2P annual budget spreadsheet, and it may look familiar based on what we talked about in our chart of accounts. Our chart of accounts is based on revenue, and then there's fixed expenses, and then direct labor and indirect labor, right? It's just like the chart of accounts. Here are the numbers right from the chart of accounts, right there, okay? It's all there. And so it's the same items. Revenue is exactly, right? It's the same right off the chart of accounts. All 4 sections of the chart of accounts is in every annual budget, right? So you have your total fees billed, total reimbursable expenses billed, your total outside project consultants fees, and we put them red so it makes it clear that those are negative numbers. And then your total project-related expenses incurred is also a negative number. It gives you your net operating revenue, right? And then you go through January, February, March, April, May, and you go down the line and you calculate what you think each one of these items are going to be based on your chart of accounts and based on the month. Hopefully from past year's data, right? You can be as accurate as you can based on past year's data. If you don't have past year's data, right? Maybe you're a startup or you haven't been tracking this at all, through the years, then you need to guess, right? You need to start somewhere. And the good news is that if you start today, next year you'll have some data to use and get a little bit more accurate. And then the following year, you'll have 2 years of data. You'll get a little bit more accurate. And then 3 years, you have 3 years of data. And you'll be a little bit, and as you go, you'll get more and more accurate and more likely that you're going to hit your targets. And so you do that all the way through your 12 months. At the end, it's going to calculate a percentage of net operating revenue and target percentage, right? And these percentages, as we get through the webinar, are going to start meaning a lot, right? So everything is a percentage of net operating revenue. So your revenue comes down here, your total revenue adds up, and your total net operating revenue is 100%. And then your expenses become a percentage of that, right? How much of that net operating revenue is going to be dedicated to fixed expenses, direct labor, and fixed expenses, indirect labor, right? You're going to do the same thing, fill out all the expenses for your firm, and those are going to calculate out to a percentage, right? And then this is your target percentage, and we're going to show you this a little bit later as well, but your direct labor expense, right? Your direct labor expense, so project-related labor expense is 30%, in terms of a calculation, should range between 28 and 32%. Okay, that's your direct labor expense. Then you calculate, you project for your fixed indirect labor expenses. Do the same thing. And that's going to come over here and total up. And then your variable expenses. So your fixed expenses are the items that are the same number over and over and over again, right? So your auto insurance bill, your professional liability insurance, probably the same number over and over and over again each year, right? And if you have a number like professional liability insurance, you may pay once per year. You don't divide that up into per month. You put it in the month that you're going to pay it, right? So if you pay that bill in November each year, then the expense for professional liability insurance should go in the November slot, right? And don't break it up into an annual payment. It's the actual time of when you pay that bill or when you receive the invoice for that bill. So you fill out each month. Variable expenses are just that. They vary, right? So professional seminar and conference fees, professional development, travel, telephone systems, utilities, office supplies, all these things are different numbers each month, right? And so those are variable expenses. And so you fill out what you expect to pay for that. And then The spreadsheet will automatically calculate all this. It'll calculate your gross profit and loss. Sorry, I just did it, Steve. I said profit and loss. It's profit or loss. Sorry. Again,
None of us are perfect.
I try. I do my best. All right. So there's another percentage. So total direct expenses, C1 plus C2, right? So you go up here and you add them up, C1 plus C2, and your total indirect expenses should range between 42 and 48%, right? That's your range. Then your miscellaneous revenue, interest, retained bid deposits, gain on assets would become revenue, and bad debt or a loss on your assets would be miscellaneous expenses. This number could be a plus number or a negative number, right? It could be a positive number or a negative number, depending on if you have more miscellaneous revenue or more miscellaneous expenses. This could be a plus or minus. And so the target is 4 to 6% plus or minus, right? Somewhere in the range from -6 to +6%, right? Could be in there somewhere.
Mark,
Yes, go ahead, Steve.
I just want to interject here that this group of expenses, the miscellaneous revenue and the miscellaneous expenses, represents what we talked about as the non-operational expenses. When you started making the difference at
right.
gross profit, you said the only thing that's not included is the deduction of the miscellaneous revenue and the miscellaneous expense, and this is what they are. They're considered non-operational, like the daily things or the weekly, monthly things that you see up above in the fixed and the variable expenses.
Right, and that miscellaneous revenue and expenses are in the chart of accounts, so that you pull out the ones that apply to your firm. So everything in this budget, other than revenue, because the revenue items come right out of the chart of accounts just the way they are. Don't even modify them. You'll have those in every budget. And then the expenses are based on your firm, right? So you go through the chart of accounts and you say, I need that one, I need that one, I need that one, I need that one. And you bring those into your budget, because some of them in the chart of accounts you won't use, right? They may not apply to your firm. You only put in here what applies to your firm. And then so you should have a number next to every one of the items based on where you're going to incur that expense on that month. Sometimes it's going to be every month. Sometimes it's going to be on the month that you receive that invoice or when you project to receive that invoice. Then your gross profit minus your miscellaneous revenue and expenses gives you your net profit or a loss, right? Because if it could be a loss, right? And so this is going to calculate out as your budget, and you're targeting 20%, right? That's what we want. We want a minimum 20%. And so you do all these numbers and items, and some of these items, and you'll see when we get into the profit plan, some of these numbers will be easier after you do the profit plan. So you do a first round with your annual budget, fill out the annual budget best you can, then go to your profit plan, and we're going to jump into the profit plan now. And then after the profit plan, you go back to the budget, because after you do your profit plan calculations, you'll have a little bit more information to finish up your annual budget. That's why those two items work together. Remember, if you have any questions, please post them in the chat box, and Steve is helping answer those questions as we chug along here. I know I'm going very fast. This is 5 weeks worth of content. We meet an hour and a half of training for 5 weeks. So an hour and a half times 5 to train this information. So I can't possibly dive as deep as I'd like to here. This is an hour, maybe 90-minute session here. But I'm giving you the basics of what we do and how we do it. Your annual budget targets. These are the percentages that I was just talking about, right? Right off the right column of your annual budget, there are percentages, and your revenue is 100%, and everything else is based on that revenue, right? All of your expenses are a percentage of that revenue. So your total direct labor, this is important. These percentages are the things that will help you make those adjustments on a monthly basis to help you survive the economy coming, right? This is super important, because these are the percentages that you can look at every month and say, oh, I have a problem here with my direct labor, right? I either need to get a lot more work or I need to let somebody go, right? When these numbers start fluctuating away from these targets, it'll help you make those important decisions. You don't want to find out at the end of the year what these numbers were, which is what a lot of us do, which is what I did for years before I learned this stuff. I would just run my business, right? At the end of the year, my accountant would say, hey, you made some profit, right? Or you lost a lot of money, right? And then I would struggle and I wouldn't know why. These percentages are why gives you the information that you can make those timely adjustments month to month. So total direct labor should range in the percentages of 28 to 32%. If they're not, they're low or they're high, then you know that there's a problem. You either have too much expense for direct labor or too little expense for direct labor, and people are struggling to get the work done. And so that allows you to make those decisions every month, right? You look at your profit loss statement and these percentages are going to show up again there. Indirect labor and expenses should range in the 42 to 48% range. Your miscellaneous expenses and revenue should range in that 4 to 6% plus or minus, right? Could be positive or negative. And your net profit should range, or not range, it should be at least 20%. It should be a minimum of 20%, right? So let's say our firm has 30% direct labor, 45% indirect labor and expenses, and 5% miscellaneous expenses. Those numbers all equal 100%, right? So 30 plus 45 plus 5 plus 20 equals 100%. And your budget is going to calculate those as you fill in the numbers in that spreadsheet. Those spreadsheets come with the course and the workshop. And so if you purchase the course or enroll in the workshop, you get all these spreadsheets, and they're all automatic calculations. The formulas are all in them, and so it all helps you calculate all that. All right, let's move on. I know we're jumping around on time here. We only have 50 minutes of the 60 minutes, so this is definitely going over 60 minutes. So I hope you can stick around. Annual profit plan. Let's look at your annual profit plan. The annual profit plan, like I said, works with your annual budget. So we just talked about your annual budget. Again, if you think about that cycle that we talked about early on, that red circle of elements, we're still above the horizontal line, right? We're still above the horizontal line. The annual budget, and now we're talking about the profit plan, are projections. They're projections of what the coming year is going to look like. This is the hard work that you do, and you actually start this typically around October for the following year, right? In order to be able to spend the time it needs to develop all of this projection work so you can start your year off fine. We're presenting it now because you need to do this now. If you don't have this stuff figured out, you need to do this before the economic storm shows up, right? So you need to get this stuff figured out now so you can get into the habit of checking and tracking and doing all the things you need to do in order to be profitable and make those adjustments. So here's the profit plan. There's two parts of it. There's the projected labor and fees billed worksheet, right? So we're going to go through this a little bit. And then underneath that, below that, are some calculations. This is the actual plan, right? So you do some work up front in the worksheet, and then you go through this profit plan. And some of these numbers over here on the right are going to inform the annual budget. And so you're going to go back and forth, like I said. So let's look at this worksheet. The worksheet takes all the people in your firm. So let's say that there are 5 people in your firm. Maria is the principal. We have 2 professional staff members, Betsy and Juan, and we have an admin staff. Jack is our admin, and we have our contract labor outsource, independent contractor, right? So that's our team of 5 people. Now, first column is your hourly rate. How much are you paying them per hour, right? Not how much are they earning, but how much are you paying them? Total labor hours is calculating for your employees, for your staff, full-time, 2,080 hours. So you calculate 2,080 hours. Everything above 2,080 hours is beyond your projection, right? And And so you're projecting a total 40-hour work week. Then you have your total labor, which is your salary, right? So we're paying Maria $100,000. We're paying Betsy $80,000. We're paying Juan $60,000. We're paying Jack $40,000. And the contract outsource independent contractor, we're paying $24,600. Again, projections. That's what we're planning to pay them for the year. Hourly rate is your total labor minus your hours, gives you your hourly rate, right? Then you have your utilization rate. Your utilization rate is how much of the direct labor, the project-related labor, your direct labor, what percentage of your total labor is direct labor. That's your utilization rate, right? So direct labor is $58,000 for Maria. That's how much that we expect Maria to earn project-related labor. So 58,000 out of 100,000 is 58%. So that's Maria's utilization rate. Professional staff, Betsy is 75%, Juan is 85%, and contract labor is always 100%, right? Because they're only billing you for the time that they're working. There's no overhead for an outsourced contractor. So direct labor, and then you have indirect labor. So your indirect labor is non-project related. So that's the 100 minus the 58,000 gives you 42,000. And if you click on all these cells in the Excel spreadsheet, you can see the formulas up here. So they all calculate automatically. Direct labor hours is how many hours Maria is spending on projects, right? So that's a calculation. D1 times F10. D10 is total hours times F10, which is your utilization rate. So your total hours times your utilization rate gives you your direct labor hours. Then your billing rate is how much you're charging your clients for Maria, right? And we're going to show you that in a couple minutes. We're billing out Maria of $145 per hour. And then you have your projected fees billed per employee, right? So you have your direct labor hours, 1,206 direct labor hours times the billing rate gives you projected fees billed. Projected fees billed is one of those terms on the annual budget, right? So you needed to know that number. That's how you get there. You fill out this worksheet. You're going to end up with a bunch of numbers that are going to be critical. You're going to end up with total projected fees billed, right? Which is going to add up here. Firm fees billed is 636,910, which is these bold numbers added up. Then you have outside project consultants fees. Oh, actually, before we get into that, the worksheet. So you'll end up with projected fees billed. You'll end up with total indirect labor. You'll end up with total direct labor for your firm, and you'll end up with total labor for your firm, right? So these are all numbers that are going to be necessary for the calculation below and some information for your annual budget. So this worksheet is critical to the rest of what we're going to work on. Now your plan, this is your profit plan. Now this is how you're going to plan your profit. This is how you're going to plan. You've done your annual budget, made some projections, right? We're going to come over here, do some calculations and some planning, and then we're going to take this information, we're going to go back to the annual budget and adjust, right? That's how you plan for profit. It's how you plan for profit. So you're going to have and again, this looks just like our chart of accounts, right? It's your total fees billed and then your total reimbursable fees billed. Total reimbursable expenses billed minus, right? Here's your revenue calculation, right? Net revenue calculation, 2 positives and 2 negatives. And this is where it starts making sense. You have your total fees billed plus your total reimbursable expenses, which includes your markup, right? So you have your firm's reimbursable expenses, You have your outside project consultants fees, reimbursable expenses. And this is the piece that matters why you're doing this negative number later, is your markup on reimbursable expenses, right? So this $9,000, which may not have been calculated in revenue if you didn't do this, is part of your total reimbursable expenses bill. It's your reimbursable expenses plus your consultant's reimbursable expenses plus the markup, right? Now you have your total outside project consultants fees, right? Which are these, hold on. Sorry, I needed a drink. In your total fees build-up number above includes outside project consultants fees, right? This $257,709 is part of your outside fees build. Then we're going to pull that number back out, or at least the fees that you incur in this calculation, just so you can see that it's the same number. We actually use that same number. So you have your outside project consultants fees billed plus your firm fees billed, and then the markup on your outside project consultants fees billed. So this $25,000 and this $9,447 are part of your revenue, right? And so this number, this total outside project consultants fees incurred, is pulling out the expense of those consultants, but leaving in the markup, right? That's why it becomes part of your revenue. So your markup becomes part of your revenue. The expense of your outside consultants come back out of your revenue. And then you have your total project related expenses, reimbursable expenses, and your direct project related expenses also come out in order to capture the markups on those. That gives you your net operating revenue, right? So we do those calculations. And again, we spend an entire hour and a half on this in the workshop. And the profit course has an entire video dedicated to this. So it's hard to get too deep on it. But total direct labor number comes right from the work you did above. Total direct labor right there, right? So now that gets popped in there. You have your total indirect labor, which is also, hold on, is total indirect labor is from your annual budget, right? So you've done the work in your annual budget, pulling that number back over here from your annual budget. Adding those two numbers together gives your total expenses. Then that gives you the numbers to calculate your gross profit. You add your miscellaneous revenue or expense. In this case, we have expenses, miscellaneous expenses, and this gives you your net profit, right? So our planned net profit is $136,151, which calculates out to 20.30%, 20%. So we're planning 20% net profit. And then it also calculates your total firm utilization rate. So you can see that our total firm utilization rate is 68%. Now, that's your profit plan, right? So we've calculated, this is a projection. We've done the work up above, then we've done the calculations below. It calculates that we're at 20% net profit. Now, if the projected profit margin is less than 20%, right? Then we need to make an adjustment. This is our plan, right? This is a what if document. Now you can say, well, what if I make this change? What if I make that change? That's how you get to where you want to be, right? So you make the changes. So if you're less than 20% in that calculation, then you either need to increase your net operating revenue, right? You need to bring in more money, or reduce your expenses. It's the only way you can do it, right? You either increase the money coming in or decrease the money going out in order to bring that profit number up, right? Every dollar that you spend on expenses is coming directly out of your profit, right? So that's how you plan for profit. And then there's some other calculations down here that help you get some of the numbers up above that we get into in the course in the workshop. But this is the profit plan. Walked you through it pretty quickly. You can come back in the recording and look at it a little bit closer, but that's essentially how you plan for 20% net profit. You do that work up front. You do the annual budget, you do the profit plan, and then you're ready. You're prepared for the coming year. Then you go back to these slides and you go back to that cycle and you go to the next item. So we've completed our projections, right? So we've done, well, we also have our project fee budget. We're going to talk about the project fee budget at the very end. That's another item that's above that line. You're projecting per specific projects, right? So as you develop fees for your specific projects, you can go through a process that we teach in the course on how to actually put together a fee budget based on having 20% net profit. But let's stick to the plan here. So we've done our chart of accounts, we've done our time tracking, and I see that we're right up against our hour. So we're obviously going past the hour. So I hope you stick around. If you don't stick around, if you can't stick around, we will send out the recording to you later. If you do choose to sign up for the profit course or the profit workshop, all the spreadsheets that I showed you earlier are included in the course and the workshop. And in the workshop, well, actually both items, I go through it in the recordings, but in the workshop, you actually go through it with us for an hour and a half. Then we do a coaching call later in the week, another hour-long time where Steve and I are both there to help people go through the process. We help you build the profit plan and the profit budget. All of it is, we hold your hand and work you through the whole process. So financial statements is the next of the 7 essential elements. You have your accrual basis profit loss statement and you have your accrual basis balance sheet. Those are the 2 financial statements. These are how you track your progress, right? This is how you track your progress. So now we're moving down below the horizontal line in the cycle, right? Now we're getting into the actual data. This is the information that's going to allow you to make the critical decisions you need to make on a monthly basis to stay profitable through any storm that we may incur. And so the profit loss statement is a financial report that summarizes revenue and expenses and shows the profit or loss of a business enterprise for a specified accounting period. So it's a financial report that summarizes the actual profit or loss of a specified accounting period. So you can pull a profit loss statement for a week. You can pull a profit loss statement for a month. You can pull it for a quarter. You can pull it for a year. You can pull it for 5 years, and it will give you how much profit or how much loss was documented in that accounting period. You can use that data. You can use the data from the chart of accounts to provide the data for your profit loss statement. So the profit loss statement is based on your chart of accounts. Just as a reminder for accrual basis accounting, it's a method of accounting in which the period of the work is performed and the expenses are recognized in the period in which they occur, without regard to the timing of the exchange of cash. So the profit loss statement and the balance sheet are based on accrual basis accounting. This is what I've been saying throughout the entire session today. Use your monthly profit loss statement to spot trends so that you can adjust and make corrections in a timely manner. That's how you're going to make it through this. That's how you're going to know where you are and where you need to be and the decisions you need to make. If you need more revenue, you need to know that on a monthly basis. If you need to reduce staff, you need to know that on a monthly basis. You can't wait till the end of the year to find out that in March you should have let someone go, or you needed another project in April in order to make sure you didn't have to let anybody go. You can't do that without tracking your progress. All right, so let's look at your profit loss statement. All right. That's right. Okay. So let's look at the profit loss statement. In this one, I have it on the slide. So we're going to stick to the slides here. The profit loss statement, this is what it looks like. This is the spreadsheet. This is basically just a copy of what the spreadsheet looks like. We're not going to jump over to the spreadsheet because I could fit the whole thing on the slide here. It's broken again. It's the same format as your chart of accounts. It starts with your revenue at the top. This is getting familiar now, right? You have your it looks just like the your annual budget. It looks just like your chart of accounts. It's all based on the chart of accounts. So you have your revenue at the top. You have your direct labor, your salary expenses next. You have your indirect expenses. You have your total expenses, which are the direct labor and your indirect expenses added up. You have your total expenses. Then you have your gross profit or loss. And then you have your miscellaneous revenue and expenses, and then you have your net profit at the bottom. So that's your profit loss statement. It's the same profit loss statement that you can print out from your software. It's not structured like this. This is a P2P format, but profit loss statement has revenue and expenses and gross profit and revenue, your miscellaneous revenue and expenses and net profit. That's how the profit loss statement. Now, the profit loss statement is also broken up vertically, where your categories are to the left, and then you have your data to the right. And that data is broken up into, for this P2P profit loss statement, it has your current month. So this is the current month data. You have your year to date. So all the data from January up to and through the month that you're referring to. So if this is a March profit loss statement, the year to date would be January, February, and March in this data. And then the third column is your year to date budget. So this is coming right off the budget, right? So you take the data from January, February, and March from your budget, and it's in that third column. Your year to date data is coming out of your actual real time data that you're working toward, and that allows you to make some comparisons. And again, you have your amount. Each one of those columns is broken up again. You have your amounts on the left and you have your percentages on the right. Back to the percentages, right? The same percentages that we talked about earlier. We have your net operating revenue at the top, 100%. Your total direct labor expenses. In this case, it's calculating the year to date, 32.6%. Then you have your total indirect expenses at 47.88%. Your total expenses at 79.94, and you have your net profit. The gross profit 20%, and then you have your miscellaneous revenue 0.25%, and then you have your net profit at 20.31%. And so those percentages come back again. Those are the percentages that you can look at on a regular basis to make those adjustments, right? So you create the profit loss statement based on real-time data, look at those percentages, make some decisions. Next month, you do another profit loss statement, look at those percentages, make some decisions. And the next month, pull out the data, you look at those percentages, and you can start spotting trends, right? You can start seeing, oh, this is getting lower and lower and lower every month. I need to make some decisions, right? Before the end of the year, where you find out you should have made those decisions in April. This is how you do it. All right. So here are our percentages again. And just as a reminder, you have those percentages equal 100%. Right? And those are those targets that we talked about earlier. So you're looking at your profit loss statement. You're looking at your year-to-date numbers. Your total direct labor expenses, in this case, 32.6%, should be in the range between 28 and 32. Your total indirect expenses should be between 42 and 48. Your total miscellaneous expenses should be between 4 and 6% plus or minus, and then your 20% minimum net profit. All right, so let's get into the balance sheet. So that's your profit loss statement. Critical document. You want to look at it at least every month, once per month, especially with an economy shifting. You want to look at it at least once per month so you can make decisions. Your balance sheet is a real-time financial report that summarizes the assets, liabilities, and equity of a business enterprise on the date in which the report is generated. Use the data from your accrual basis balance sheet chart of accounts to provide the data for your balance sheet. All right, let's look at your balance sheet. Again, this fits on one slide, so we're sticking to the slides. All right, So on the left side, we have our categories. On the right side, we have our data. And that information is broken up into your assets, your liabilities, and your shareholder equity. Your assets are broken up into current assets and fixed assets. Your liabilities are broken up into current liabilities and long-term liabilities. And then you have your shareholder equity at the bottom. What's an asset? An asset is cash or any item of economic value that can be easily converted to cash. So when you look at your assets here, right, this is your cash or anything that can be converted to cash. And your liabilities is an obligation to pay debt. So it's something you owe to someone else is your liability. And a shareholder is an individual with an equity interest and ownership in your firm. So if you have a partner, you probably have 2 shareholders. If you have 2 partners, you have 3 shareholders. If you have an investor, you have 3 shareholders, and an investor would be 4 shareholders. If you're a sole practitioner, you have 1 shareholder. Equity is the value of the stock or other security representing the ownership interest in that firm. So it's the value of the ownership. Balance, total liabilities and shareholder equity always equals total assets. Liabilities plus equity equals assets. That's why it's called the balance sheet. So let's look at that. We have our total assets balance with our total liabilities plus equity. Same number, 510,236. So our assets always balance with the total liabilities. And let's look at it this way. Assets is everything that the firm owns, right? Assets are everything that the firm owns. And liabilities, everything that the firm owns is owned by someone, right? So assets is everything that the firm owns, right? The firm is a separate entity than you, right? So everything that the firm owns is an asset. And then those assets are owned by somebody. It's either owned by somebody else that you owe, right? Which is debt, or it's owned by you or other shareholders. That's why it's a balance sheet. So you have everything that's owned by the firm is owned by someone else or owned by someone, either you or someone else. So that's the balance sheet. Let's get into the key financial performance indicators. I recognize that. I'm just going to do that. Okay, so I'm going to your key financial performance indicators. Okay, there are 12 for your profit loss statement. There are 12 for your profit loss statement, and there are 4 for your balance sheet. Okay, so they are the net multiplier, your total direct labor to net operating revenue, your ratio of outside consultants fees billed as a percentage of your total fees. So how much are your total fees going out to outside consultants as a percentage of how much your total fees are, right? And so these are performance indicators. These are all, you can look at these numbers, identify where the target number is, and gauge on how you're doing on a monthly basis. You can take the data, plug them in, and I'm going to show you a few of these. I don't have time to go through all 12 of them, but you have break-even rate, you have your break-even cost, your proposed project fee for the firm, you have your utilization rate is a KFPI, your net profit is a KFPI. These are all things that you can look at, track on a monthly basis, and in order to make real-time decisions. Net operating revenue per professional technical employees, right? So how much of the net operating revenue per employee and how much of your net operating revenue per your professional and technical employees. And then your aged accounts receivable. Those are your 12 P2P KFPIs. A lot of letters there. 12 KFPIs. Those are the 12. I'm going to go through a few of those. Then the 4 for the balance sheet. You have your solvency, you have your liquidity, you have your leverage, and you have return on equity. That's pulling data out of your balance sheet, and you can make decisions based on those 4 items. Let's just go through a few of the KFPIs for your profit loss statement, because I know that we're running out of time here because we can't spend all day here as much as I would love to. I know you're busy too. So you have your net multiplier. And in the past, when I've done this session, I've tried to rush through this information and then didn't get enough of it, presented well. So I've decided to just go late. Hopefully you don't mind. Hope you stick with me. Net operating revenue divided by total direct labor. If you're interested in the workshop, I'm going to talk about the workshop at the very end and give you all the details about it. Also going to give you a bonus that no one else is going to be offered. So if you're interested in the workshop, stick around till the end. Your net multiplier is your net operating revenue divided by total direct labor. So in this case, that's information coming right off of your profit loss statement, right? Those numbers are right on your profit loss statement. You take the net operating revenue divided by your total direct labor, and you get a number, 3.12, and your target is 3.25. 3.25 is your target. So, or more, right? So we're low here in this case. This firm is a little bit low. Then we have our total direct labor divided by our net operating revenue, right? And that's a percentage. That's one of those percentages that we've been talking about all along, right? That target, 28 to 32%. That is a critical KFPI. Remember I said when you were looking at your profit loss statement, you can look at those percentages and make decisions. That's because it's a key financial performance indicator. That total direct labor in relation to its net operating revenue, the percentage of your total direct labor is probably the most important KFPI you can look at, because then you can make some critical decisions based on workload and staffing that's what will get you into trouble, right? Your workload and your staffing is what will get you in trouble in the economy. And I can tell you that from firsthand experience. I didn't know that, and I went way too long, and I held on to staff when I didn't want to let them go, and I struggled with them for over a year, went into a lot of debt trying to keep them on because I didn't have the work coming in and I wasn't tracking the information that I needed to track. I didn't have the KFPIs to look at. If I did, I would have made those decisions much sooner, and I would have had to let people go. It would have hurt, but I would have seen in the numbers, if I don't let these people go, the trend is going to continue and I'm going to end up in a lot of debt. I ended up in tens of thousands of dollars of debt because I didn't have this information. And we don't want that to happen to you, which is why we're doing this. So you need to track this. Ratio of consultants' fees billed as a percentage of total fees billed, right? That's another KFPI. So your outside consultants' fees billed with no markup divided by your total fees billed with no markup. In this case, 20%. Your target is 25 to 30%. The lower is better. So we're doing well here, right? The lower the markup, the lower the fees from outside consultants, the better, based on your total fees. Overhead rate. Your overhead rate is your total indirect expenses divided by your total direct labor. The target is between 1.3 and 1.5. And in this case, it's 1.49. And what do we have? And then you have your break-even rate is your total overhead rate, which we just calculated, 1.49 plus 1. And that range should be between 2.3 and 2.5 in the range of direct labor. So those are the 12. Those are the 12. We go deep into each one of these in the course and the workshop. And these are the 4 for your balance sheet, which we're not going to go into today, but we do go into in the workshop and the course. And the last piece, you may have seen this workshop, this webinar advertised as 6 essential elements because in the past we skipped project fee budgeting. We added it back because we do teach it in the workshop. It is in the course as well, project fee budgeting. It's actually my favorite piece because you can actually calculate profitable fees for your projects. Who would ever think? What a great idea. So we teach that, and I wanted to just bring it into the workshop or the checklist webinar here today, knowing that we were just going to go over our 60 minutes. So the basics of this, we're not going to get into the calculations, but the basics of putting together a profitable project fee, there are 3 ways to do it, actually 2 ways, and then there's a verification. So I'll show you the top-down budget, top-down project fee budgeting, and the bottom-up project fee budgeting. Top-down typically is probably for public work or institutional work, where a client comes to you. Let's say it's a school system, and the school system has this big renovation project, and they've decided that their project is going to budget is going to be $40 million, and the fee for architects is $1 million, right? And they've determined that. That's what it's going. That's how much they're going to pay the architects. So they're giving you the fee. So a top-down project fee budgeting is going to determine whether you can do that project for their given fee at a percentage of 20% profit, right? Or minimum, right? A minimum of 20% profit. And so the calculation that we would go through is you take the fee, you minus out the principals, subtract the principals, hours, consultants, and non-reimbursable expenses, and you end up with your net fee. Then you multiply that by the hourly billing rates of the people who are going to work on that project, and you allocate the fee by department and phase, and then you estimate the staff hours for those fees, and you get a scope of work that you can perform at that given fee that the client is going to provide you, right? So you figure out how many hours you can spend on that project, right? How many hours it's going to take you to do a project. And the calculation that you would go through that we teach in the course in the workshop will identify whether you can do that project at the given fee. If you can't, then you have the information calculated to be able to go back and negotiate that fee, right? Now you have some information, some data, some numbers to go back to that project fee, because that $1 million may look really great, right? It's $1 million fee. But what if it takes you $1.2 million to do the work, right? When you do this calculation and it turns out, well, you're 200 grand over. You can go back to that client and say, well, we'd love to do this project, but here's what we can do. We can reduce the scope of services that we provide and still hit that fee, right? And so if you did those calculations, you'd be able to do that. The other piece, which probably most of us here, small firm architects doing small commercial projects or residential projects, we use a bottom-up project fee budgeting. So you start from the bottom and you work your way up. You start with a request for proposal, right? A client comes to you and says, hey, I got this project. I want to put a new addition onto my house. How much would it cost me to put this addition on my house, right? So they come to you with a request for proposal. You determine what the scope of services would be required to complete that project, right? Then you estimate the hours that those services would require by your staff, by department and phase, right? So you break it up by phase and by the people who are going to work on that project. You multiply that by the break-even rates, which you've calculated prior, right? And then you have a fee allocation by department and phase. I'm losing my voice. And then you add in the principal hours and the consultants and the non-reimbursable project expenses. So you know that you have all of those pieces calculated, and that will give you a net fee, and then add in the profit and say, here is my fee, right? So you calculated what the cost of overhead, what the labor and the overhead would be, plus profit through this calculation of bottom-up project fee budgeting. And it would calculate a number. And then you present that to your client, say, here's what it would cost us to do that project that you proposed. And so that is a process that we go through in the profit course and the profit workshop. There's also a calculator that we give for free at the Profit Tools. If you go to EntreArchitect.com/profit tools, you can actually download the calculators that will allow you to do this without the course or the workshop. If that's all you want, you could just go grab that. That's free. So EntreArchitect.com/profit tools are calculators that you can calculate these really easily. And the third piece, and we're almost done here with the webinar. Then we'll get into the workshop information. basically the third piece is to start, if a client comes to you and you have this top down, you go through that top down calculation, and then you go run it back through the budget, through the bottom up process, and verify that the fee works with the fee that they're giving you, right? So you can calculate the scope of services, then take those scope of services, bring it over to the bottom up process, run it back up through the bottom up process, and look at the fee that you will calculate through the bottom up process and see how it works with the fee that was given to you. They'll give you additional information to be able to negotiate with. So those are the three ways of calculating a budget, a project fee budget. I'm hoping that helps. If you have any specific questions that you'd like us to answer, please post them in the chat box or the Q&A box. Steve is monitoring. He's been answering those questions on chat. But let me go through the workshop while that happens. So if you have any questions, please post them in the Q&A, in the chat box or the Q&A box, either one. We're monitoring them both. And if you have any questions about the workshop or the course, I'm happy to answer those as well here. The reason we offered, like I said in the beginning, I don't know if everybody was here at the beginning, but the reason we offered all of this, the workshop, the webinar, and the course, it's all out there for you, right? This webinar was here for you to sort of see how the P2P process works. If you want to dive deeper, you can go to EntreArchitect.com/profit course. There's information about the course and the workshop. The workshop is a 5-week interactive training program that will help you do this process. Steve and I work through it with you live for 5 weeks, hour and a half per week. So 5 live training sessions. I present those training sessions. Steve is there with live support, much like today. I present it. Steve is there to keep me honest and to support everybody along the way. More than 7.5 hours of training. So 5 weeks, an hour and a half. And the training includes full Q&A sessions. So we teach it, we answer the questions, and then we come back. We use Zoom, just like we're doing today. Then we also do a coaching session as well. So program training is based on the P2P system developed by Steve. He's the author of Design Professionals. Over 25 years of development in this system. It is the only system that's been developed specifically for architects. And like I said, it's the system that the AIA publishes in their handbook. In addition to the training, there's 5 group coaching calls. So we do the training on Tuesdays. We do the coaching calls on Thursdays. One-on-one help. All the templates and calculators are included in the course and the workshop. Again, to clarify, the course is pre-recorded. It's also less expensive. The workshop, which I highly recommend if you're serious about it, go for the workshop. It is an investment in your future. Definitely do it because we work through it with you and we make sure that it works. And we're there, and we're still there with past workshop members. And you get all the templates and all the calculators that are that I showed you today. Plus, we did a whole bunch of other easy-to-use calculators that's based on those pieces. There's also an online resource portal that's just private to the members that has all the recordings from each session. Then there's a workbook, downloadable PDF that sort of guides you through the process. We have members have their own Slack groups. So everybody in the session is working together on this. So not only are you working with us, you're working with everybody else in the workshop. Every session is recorded and shared, and you have full access to me and Steve all the way through and beyond. Like I said, people who have been through the workshop, we're still working with them. Steve is working with them on a weekly basis with some of them. We're there for that accountability, right? That's what's really important, is the accountability. It's a fully developed financial management system with all the resources and then the support that you need so you can prepare for this economic storm that's coming. This is how you're going to get through this. Starting June 9th, you have your training and your coaching. The price is typically it's $1,995. We've reduced it $500. It's a one-time payment of $1,495 for the training, for the 5-week workshop. The course is less, but the training is where I recommend. If you had private consulting from someone like Steve, it could easily, your firm would pay $5,000 to $10,000 for the same work that we're going to go through. If you hired somebody to come to your firm and do this one-on-one privately, it would easily cost $5,000 to $10,000, right? And so this is by far way less expensive than hiring. And we do the same thing. We do that same one-on-one hand-holding. You're just doing it in a group, and so we can keep it at a lower price in order to have this work.
Mark?
Yes, Steve, go ahead.
The only thing that I would say about your comment, you could hire somebody to come to your firm and do this, is there is no one to hire except me.
That's right. Well, you would charge a lot more than $1,400 to show up at somebody's office.
That's true.
Right. So the and if you earn 20% profit, you could easily 10x the investment of $1,495 easily.
And
right?
they get me and you together throughout the whole 5-week interactive training.
Right. During the trainings and the coaching. Twice a week.
Twice a week.
These are some quotes from past members who've gone through the process. Ed says, 15 years into running a small firm, the P2P workshop was exactly what I needed to fully grasp and guide the financial condition of my business. I now understand the key indicators that signify healthy performance and how to make a real-time adjustments necessary to achieve my profitability goals. This is a man who's been in business for 15 years, right? And now he's going through this process. Jefferson said, Mark and Steve offer a no-holds-barred look at the numbers behind the operation of your architectural business. The P2P Profit Workshop is a deep dive into establishing a proven financial management system for your firm with the patience and empathy needed to make those numbers clear and useful. That's key. That's why I posted this, because we're there to work with you, right? Hold your hand. We'll work through the process with you until you understand it, right? Until you understand it. Gail says the P2P Profit Workshop was exactly the concise boot camp I needed to give me the tools to better manage my firm. It helped me and continues to help me evolve into a thoughtful manager with the focus on, dare I say it, profitability, not just great design. It was an investment long overdue. I wanted to better understand how I was making money in order to ensure that I would be best positioned on the other side of this economic downturn. So she is not only preparing for the downturn, she's preparing to come out on the other side profitably. So you could register right now at EntreArchitect.com/profit course. You could purchase the course or enroll in the workshop. You can go there for both of them. Enrollment closes next Friday, right? So a week from this Friday, the session starts on the 9th, which is the Tuesday following that. Enrollment closes this Friday. We're going to give you a free bonus. I'm going to give you a free bonus. I have a course that I put together last year called the EntreArchitect Small Firm Planning Course. It's 8 steps to accomplish your architecture firm's single most important goal. It is a process of planning. It will help you. This is the other piece of it, right? Get your financial management system figured out and then put together a plan in order to make sure that you are focused on the thing that's most important in your firm. This is a course that goes through that process. If you enroll by this Friday, in order to get this bonus, you have to enroll by this Friday. So today's Wednesday. If you enroll by the end of the day, Friday, I'll give you this course. It's a $200 course. It's a $197 course. So that's free if you enroll by Friday, this Friday, the 29th. It'll help you identify the single most important goal for this year. So you get, if you enroll in the workshop at $14.95, you'll get the profit course. Also, I didn't even mention that. You get the profit course for free if you enroll in the workshop. That's a big piece. I forgot to delete. I left that out. If you enroll in the workshop for $14.95, you get the profit course, which is $495. You get that for free. So you get the $500 video course for free if you become part of the workshop. Steve is signing off. Thank you, Steve. We'll talk to you later. So if you enroll in the workshop, you get the profit course for free, and you get the small firm planning course for free, which is $197. So about $700 worth of free training if you enroll in the workshop. So you get 5 live training sessions. You get the coaching calls, you get the templates and the calculators, you get the portal, you get the workbook, you get the peer groups on Slack, you get the sessions recordings, and you get the support and expert guidance from me. Thank you. I see all the thank yous. Thank you all for attending. I appreciate you all. EntreArchitect.com/profit course to enroll in the course or the workshop. Remember, if you enroll by this Friday, right, you can enroll at the workshop until next Friday. You can get the course by next Friday. If you want the bonuses, you need to enroll by this Friday. So enroll right now. Also, 30-day money-back guarantee. 30-day money-back guarantee. If you do this course or the workshop and you don't think it's worth the money, just email me and I'll give you your money back. This is not about making money. This is about giving you the information you need to be profitable. And no one ever asks for their money back, but we've always given a money back guarantee to everything we do, all our products, all our courses, all our workshops. No one ever asks for it, but it's there. If that makes it easier for you to make that commitment, I want you to do this with me. I want you to do this with Steve. EntreArchitect.com/profit course. I would suggest that you do that right now in order to get those other courses. Those courses are pre-recorded. The profit course and the planning course are pre-recorded, so you can grab them now. The planning course will go on sale later this year for $200. You'll get it for free if you enroll in the workshop. You don't get it if you enroll at the course. So you have to enroll in the workshop. You can go to EntreArchitect.com/profit course. Go to the checkout. There'll be an option for the course and there'll be an option for the workshop. Just pick the workshop and you'll be set up. You'll get an email that will show you what you need to do next. If anybody has any questions about the workshop or the course or anything that I talked about today, I'm hoping that what we presented today gives you enough information to go back to your own financial management systems and make sure that everything is there, everything that you need is there. Just go through the checklist, right? Just go through the checklist and make sure that everything in your financial management system is working. Make sure that you have a chart of accounts. Make sure that you have a way to plan for profit. Make sure you have an annual budget. You can't do the rest of it without the annual budget, right? You can't do the monthly tracking to see where you are based on where you had planned to be if you don't do the annual budget part, right? So if you don't go through the process of budgeting and planning and then tracking and then KFPIs, right? And then being able to estimate your fees based on a profitable fee, right? To calculate, we'll show you exactly how to do that. If you don't have all those things, you need to do that, whether you buy the course or whether you enroll in the workshop or you do it somewhere else. I don't care where you do it. What I want is for you to be successful. So I want you to make sure you do it. And that's the intent of this webinar, is to be able to provide the information, the checklist that you need to go through that process. So if you enroll before Friday, EntreArchitect.com/profit course. If you have any questions, you can email me at mark@EntreArchitect.com. I'm happy to answer any questions that you might have. Jessica's asking about the bonus. Let me just go back to the bonus. The bonus is here. If you enroll in the workshop, it's only for the workshop, right? Only for the workshop. If you buy the course, you get the course. If you enroll in the workshop before Friday, this Friday, you'll get the course for free, right? The course is $495. You'll get that for free if you enroll in the workshop. And you'll get the EntreArchitect Small Firm Planning course, which is a course that helps you achieve the single most important goal. Identify and achieve the most important goal in your firm. Okay? Does that make sense, Jessica? So you get the profit course and the planning course. The profit course is the information that we just went through, pre-recorded, in depth. It's the same content that we teach in the workshop, but it's all pre-recorded. That's the course, the profit course. And the planning course is a course that will come out later this year for sale that identifies a single most important goal in your firm and how to achieve that. So it's identify the goal and then gives you the strategy and the process of how to achieve that goal, right? What do you need to do in order to achieve that goal on a daily basis? We go into the course on that. All right, so that's it. Great. You're welcome, Jessica. Everybody, thank you very much. You're all very welcome. I see all the thank yous. I thank you all for being here. Let me just see. Thank you, Carmelo. I appreciate you. I appreciate you, Valeria, Jessica. Let me see if I can get this name right. Nakrang, thank you. Janine, Kenneth, Scott, thank you all for being here. I appreciate you. I hope to see you all at the workshop. At a minimum, buy the course. Please, or don't buy the course and do the work somewhere else, but do the work. This is how we're going to get through this economy. This economy is going to go bad. And the only way you're going to be able to make it through is to be able to understand your financial management system. What I like most about this course that we go through and this work, especially the workshop, is that you finally, as an architect, not only get the system you need, but this is the feedback that we get from our members, is that they finally understand how to use it, finally understand what the profit loss statement can do for you, right? I showed you that today, what the balance sheet can do for you. What are those percentages? How to look at those percentages, how to look at a profit loss statement and know what you're looking at, and then say, okay, I need to make this decision in my firm in order to stay on track for the plan that I created. That's what we're teaching, right? We're teaching we're giving you the course, we're giving you the structure, we're giving you the method, but then we're also teaching you how to use that method forever, right? As an architect, once you learn it, you never need to learn it again. So go to EntreArchitect.com/profit course, buy the workshop before the end of the day on Friday, and we'll give you the pre-recorded course and the planning course for free, over $700 or almost $700. I'm not doing math. It's been a long time. Thank you all for being here. Let me just double check, make sure we have all our questions answered. Yes. Okay. EntreArchitect.com/profit course for the course or the workshop. I hope to see you at the workshop. Have a great day. We'll see you soon. Thanks for being here.